Okay, so question 3 and 4 are also under petroleum and mine. These are just past questions I sampled. So you go and check them out. Okay. The same principle we've talked about here applies. So 3 and 4. Can go check them out. You can try them yourself. Same principle. So now another key aspect, insurance business. Insurance business. Before I move on, anybody has any question? Are you all okay? Now, okay, so I'm moving on. Insurance business. Right. So now, the act categorizes insurance business. We know insurance. So basically, we are not going to be learning insurance in detail like that, like the principle behind it. And the act considers two major types of insurance: general insurance and then the life insurance. So basically, our approach is going to be considering the income and then the revenue aspect of what the insurance business, the income or the revenue aspect of insurance business, and then how it is what taxed. So basically, that's where our focus is. Oh, hello, Anastasia. Hello, please can you? Interesting. Please can a minute, please. Okay. So now when it comes to insurance business, when it comes to insurance business, I'll give you a format. Go with the format. How just stick with it. Apply it. When a question comes, look at the format. Go with it. So the idea is this: for computation of chargeable income of insurance business. Okay, so there's the format. Now it starts with, you see, insurance businesses normally receive what we call premiums. So that's what we start with.
So, sir, you are
Gross,
doing that of the general insurance.
yes, please, generally. I'll talk about the life insurance. So gross premium received. It's as simple as, so basically like this. And then you less any, you see, premiums are basically what your customers pay when they insure their losses or their risk with you. So they are basically what they pay you, which means that's basically like your major source of what? Revenue. So gross premium receives. If it happens that you retain any premium, you have to less it. So less any premium you might return. And also sometimes you might reinsure some of the things that your customers insure with you. You might reinsure them with other insurance companies. So once you reinsure them, you will also pay premiums, right? So you also less any reinsurance premiums paid. You less any reinsurance premiums paid. You less reinsurance premiums paid. So whatever you get here becomes your net premium. Now, then you move on to what you call recoveries. So sometimes you might be able to recover what you reinsure. Let's assume you reinsure your loss against or with other reinsurance companies. Sometimes you might recover when the loss occurs, you might recover whatever you get from them. I get it. When they indemnify you as an insurance company. So that is an income. So you add its reinsurance what recoveries. Reinsurance recoveries. You add it. Then if you happen to pay any claim, so you might also pay any claim. Like let's assume the loss that your customers incurred with you, it occurs, and you pay. So claims paid. You also less that. Then you move to what we call reserves. Sometimes there might be certain risks that have not expired. So you create some form of reserve to cater for those risks, right? So for reserves, your opening reserve that you start with. So your opening reserve you start with is added. Then you less the closing reserve. So you add your opening reserve, you less your closing reserve, then you can add whatever you get. And then if there is any investment you did with the insurance, the whatever you got from the insurance, you add other income or any investments or income. When you are done, you will less allowable expenses. Now, these allowable expenses can be the normal general administrative expense or even commission that you pay to what? Agents. So you less allowable expenses. Then you bring whatever you. So once you are done, you get your accessible income. And then you less capital allowance. So here, sometimes they allow, in fact, not sometimes, they allow the rules on capital allowance under section 14 and then the schedule, right? Which we know basically class 1 to class 5 thing. So less capital allowance. Then we get our chargeable income, on which we compute our tax at a rate of 25%. Right. Any question, any issue. Me, when I was preparing for CA and I got this, I didn't even bother stressing myself with the learning. I just got the format now in my head. if it had come, I would have written the format down. If there are any tweaks, I'll think about it and then work around it. But then generally, this is the blueprint. You work with it. Any question before we start solving the question? Any issue, any question? Okay, so can we comfortably start? Right, I'm taking that as a yes. Okay, so with my blueprint, we are solving the question. Please, I need a reader. Who will help me read? Who will help me read, please? Hey, why? Has everybody gone off?
We are here.
Please, I'm listening. Help me read, I beg.
Okay, let me read.
Okay.
Is it a question? Okay, is it question
Yeah,
6 or 5?
requirement first. Question 5. So
Okay,
requirement first.
required. Okay, sure. Compute the tax liability of the company for the 2018 year of assessment. What would be the position if it had been a life insurance company? Corporate
Thank
tax
you very
rate
much.
25%.
Thank you. So let's answer the question.
Flourish Insurance Company Limited commenced operating in Ghana on 1st January 2018. Below is an extract from the trial balance as at 31st December 2018. The
Right.
currency
So
is Ghana
basically,
cedis. So we have the bill. Okay, so I should ignore. All right,
a
then
lot
go
of
to
these
the
things, right?
question.
So now let's start with our formats. I think we can go around it. So let's start. Let me open this up a little. Oof. So Ghana cities, right? So gross premium received here, right? So basically, it's just with our formats, we go with it. So 920,000.
20,000.
And then if there are any premium returns, we less it.
Mm-hmm.
That's like basic accounting in SHS. So premiums returned to clients, we less that's 19,000. Let me bring it here. Also, reinsurance premiums paid.
Mm-hmm.
That's here, right?
Yes, sir.
So 5,400. So once let's add this, we get I think 24,400, right?
Mm-hmm.
You less this, whatever you get is your net premium.
Okay.
What are you getting?
895,600.
895,600.
Mm,
Right. Then we come to our reinsurance recoveries. Now, what were some of the recoveries that were made? Reinsurance recoveries, 180,000. So let me bring it here. Okay, let me bring it here. We are adding this, we are lessening that. So then any claims paid. So if we happen to have paid any claim, we less it from the recoveries we made. So claims paid during the year was 320,000. Once you less, I think the difference will be a negative value of looks like 14. So 140,000.
Yeah.
All right. And then opening reserves is added. Closing is what? Is less. Let's look for our opening reserve value. So I think we have our reserve being calculated as 40% of the net premium income. So this is the reserve for this period that we'll close with. What about opening? Okay, so I think that's also our opening reserve is dash. Closing is 40% of the net premium, right?
So say every time they'll give us the opening reserve.
Sometimes they give it to you, but you see they're giving you the closing reserve.
Mm-hmm.
So whatever they give you here normally is the reserve you are closing with, the reserve for unexpired risk. Okay.
Mm-hmm.
So basically 40% of the net premium. Please help me with it.
Okay. 358,240. Three,
158.
three, 358.
Oh, okay. So 358,240.
40.
358,240. 358,240. And then we have any other investment income. So we add other investment income. Now for investment income, let's check the question. I think we have interest received on loans, right? And then also interest in our investment.
Investment.
So I think we have 61,000. So please, when I'm actually solving a question, write them. I think because of the formats I laid down, that's why I'm doing it this way. So 75,000. That gives us, I believe, 136,000. And then allowable expenses. Depreciation is never allowable, so we won't even bother with it. So let's look at other expenses. I think we have general administrative expenses,
Yes.
also commission to agents, right?
Yeah.
Add the two. So we have 350,000 minus, sorry, plus 24,000. That looks like 374,000.
Mm. So can you be separating them or you can just do them as
Yeah,
you've done here?
I'm saying you should actually separate it, but because I laid down the format, that's why
Okay, okay,
I
okay.
don't want to clean and then you should actually do that for max.
Mm-hmm.
So basically you less the 374,000 to get your accessible income. So please give me the value for accessible income. I think it starts from here.
So
Um,
underline the 140. Oh.
I think so it's basically from here. 890 minus this plus
Mm,
this plus this minus this.
okay. Mhm.
Um, you don't say that on the- Yeah.
1,623,840.
Please come again.
1,623,840.
That's interesting. 1 million.
Sorry, yeah. A minute, I think. Let
Then
me check.
this
Let me check
plus
my figures.
okay.
So add on 36. Okay, and then less closing reserves. Okay, the closing reserve is less rather. Okay.
The closing
I
reserve, is
think
it not?
I should have deducted the close reserve.
Yeah, sorry. Less.
Um,
I added it.
Okay.
Which one? Okay.
Hey. Hey, nobody's guessing the value for me.
A minute.
Con-
Okay, 159,360. I hope we all had the same thing.
159.
360.
Yeah, I think this one looks more realistic. 360. Then we
Yes.
less our capital allowance, right?
Mm-hmm.
Yeah, I think the whole thing is jumbled up. I'm sure if you watch the video, you follow so. Less capital allowance. Now it means we have to go and compute our capital allowance, right? Per section 14, I believe. Okay, so capital allowance. And we all know capital allowance, how capital allowance works. Basically, is the replacement for depreciation. The replacements for depreciation under Act 896. Eminent, please. So basically, it's applied on depreciable assets. And capital allowance classify depreciable assets under five pools or five classes. Basically, class one, class two, class three, up to class five. And we know class one. What does class one entail of?
Computer and
Class one.
assessment.
So basically, computer, peripherals, and other data handling equipment, right?
Yeah.
Class two.
Still, visual motor, uh, automobiles.
Yes, so basically road vehicles,
Mm.
as well as plants and machinery used in what? Factory.
Manufacturing.
Yeah.
And then gensets.
Yep. And then class three.
Any other? I said that is not in class 1, 2, 4, or 5.
Thank you very much. And then
That's
those
how I
office.
learn.
So those office office things as well.
Yeah.
And whatever you said, that one you said. And class four
So,
is
assets of permanent nature.
very good, like buildings and others, right?
Yes.
And then class five basically is intangible assets.
Intangible
Thank you
assets.
very much. Now, the act also provided rates. So class one is, what is the rate for class one?
40%
40% reducing balance, right?
balance. Yes, please. Class 1 and up to 3.
Reducing
Missing
balance. Then
balance.
class two is what? 30,
30%.
20%. All
Yes.
these reducing balance, like you said. And then class four is what? Straight line, which
10%.
is
Straight
building
line.
10%. Hey, what did I say building? So 10% straight
10%.
line.
Yeah.
Class five over the useful
Number of
life.
years. Yeah. It's for
Thank you very much. Also, there is this caveat that class one to three assets are all placed in a pool, right?
yeah.
All assets are placed in a pool and then capital allowance are charged. But then for class four and five, each asset forms a pool of its own. So for each single asset in class four and five, you compute the capital what? Allowance.
Allowance.
So let's start. So looking at this insurance company. I think let's look at the assets they have, and then we'll know the capital allowance to compute for them. So they have building, which is class.
Building is class 4.
Great. Motor vehicle,
Class 2.
F and F.
Patients are put in class 3.
Thank you very much. I think that's all they have. So basically, in our capital, even they give a rate here. In
Mm-hmm.
our capital allowance, we have class 2, class 3, class 4, and then the total. Right. So
Yes.
basically, we start with our written down value brought forward. So they didn't bring down any value, but then the question said the assets were acquired on 1st January 2018, right?
Mm-hmm.
So no written down values here. So this 30%, 20%, 10%. But then there were some additions because of the acquisition, right? So
Mm-hmm.
additions for class 2, we have 608, sorry. Class 2 is 210,000. Class 3 is 140,000. Class 4 is 650,000. Then we compute our capital allowance on this, right? There is the basic form of capital allowance. So 30% of this, please help me with the values. I like the 10% on. So there is 65 million. 20% also looks like 28,000. So please, what is the 30%?
Hello, sir.
Yes, please.
Please, I wanted
This
to
is
get
it.
clarification on the motor vehicle at
Yes,
cost.
please.
I remember there is a law that limits it to 75,000 if it is not used in production. This motor vehicle, since
That's
it is silence, are we going to treat it as getting capital allowance on full cost, or we subject it to that limit?
great. So it's not about just motor vehicle engineering, it's about non-commercial vehicle. So if it's
Vehicles.
a non-commercial vehicle, that's where it is limited to what the 75,000 you are mentioning. But this one, they just give a generic motor vehicle. We are not going to limit it unless the question gives an information that implies that it is a non-commercial vehicle, where we are going to charge or we are going to limit the capital allowance on a value of what? 75,000. Please, are you okay?
Okay. All
All
right.
right.
Thank you.
Thank you. So basically 63,000 here. So please give me the total of the capital allowance, because that's what we are even interested in. I'm not even going to bother with the rest. So please, this plus this plus this.
156.
150,000.
106,000.
And that's what we are interested in, right? For our insurance
Mm-hmm.
company. So we send it 156,000 here for capital allowance. I think we are left with only 3,360 as chargeable income, right?
Yes, please.
And this is taxed at 25%. So 25% of this will be 8 something.
840.
840. Great. Any question, please? Any question? Okay, so B is saying, what would be the position if it had been a life insurance company? Life insurance company, simple. For them, they consider only the investments cost or the interest or the benefits to shareholders on their investments, and then the allowable expenses. Once you do that, you have your chargeable income. So what I'm saying is, if it was a life insurance company, we would only be interested in this portion. of the week. Only this portion of the week. If it was a life insurance company, we would be interested in the investment income and then the what? Allowable expenses. Are we okay? So
Yes, sir.
basically, so the answer for the life insurance company is that portion of the week. So basically, for a life insurance company, it is the investment income. Investment income. So basically, what was the investment income? I think interest on loans and then interest on investments. I believe one was 61,000. The other was 75,000, which gives us a total of 136,000. Then we less our allowable expenses or our general administrative expenses. So general admin expenses. And then the commission to sales agents. I think this one was, let me check it. Yeah, so 24,000 for one. And 350,000 for the other. So we get 374,000. So please let's less it. I think we get a loss, right?
Mm-hmm.
Remember loss, how it's treated. Carryover.
For 5 years.
Thank you very much. In the order in which is incurred. Remember, there is no longer priority and the non-priority sectors. I'll be aware of that change. So please, what are we getting? We'll make a loss, actually.
-238 negative.
To negative 238,000. It's a loss, right?
Yeah.
Great. So insurance companies. Now the next question is also a past question I added so that you guys, I'm just trying to point you to the past questions because they are very important. Past questions are basically what is on grounds, what has come. So it's very, very, very important. You can't have gone for CA exams without reading past questions. It's very, very, very important. We teaching centers will do our part for you, give you the format, solve some questions with you. But what is actually happening on grounds are the questions themselves. So please, I added some of them to try to point you to them. So to look them out and then find ways of what dealing with them. These are the format, these are the approaches to solving them. Practice on your speed, practice solving past questions, and you'll be good to go. So we are going to take about 20 minutes break and then we'll return and then continue with the rest of the questions. I think from here we'll move to today's the first session. We'll do another session which covers the other areas not covered. So basically from here we are moving to international taxation. We'll talk about the double taxation issues as well as transfer pricing, among others. And the transfer pricing, there is a key topic known as functional analysis, which we'll look at. Yeah. And then we'll do a question on partnership taxation, as well as, I think, installment payments. And then I think we'll call it a day for today. Any issues, any question before we go for the break?
So please, when are we back?
Oh, in the next 20 minutes. So basically, 3:50. So we'll be back at 3:50.
Okay. All right.
Sure. All right.